Hello dear students, welcome to Devika's Commerce and Management Academy. Banking accounts, introduction I gave you in the last class. Today we'll see banking accounts balance sheet format. Very easy to prepare. Don't get scared by looking at the board, ma'am, you have written a lot. Very simple, I'll make you to understand. So first balance sheet we'll see. Balance sheet in company accounts, did you remember? That format is different. But in banking account, balance sheet format is different. RBI has specially mentioned a particular format for the banking companies, balance sheet format. So that has come in the implementation on 31st March 1992. 31st March 1992. Since that day, so same format is following by all the banking companies. They have mentioned schedules, 12 schedules they have mentioned. The same schedules we have to follow. Same prescribed pattern you have to follow. We cannot change as per our wish. And very easy to remember. Let us enter into the topic. Form A. Form A is balance sheet is mentioned by the RBI. Next, Form B. Form B is profit and loss account. That we'll see in the next class. But today you have to understand balance sheet format. It is lengthy. And Form B, profit and loss account, is quite easy. So that is why I want you to focus Form A first. Form A, balance sheet, 0 zeros, triple zero is omitted. Why triple zero omitted? 3 zeros are omitted because in banking the figures amounts are very lengthy. It's very difficult to write in the amount column. So that is why we always omit the 3 zeros. If the amount is suppose say 70 lakh, 70 lakh. 70 lakh means how many zeros comes? 70, then 5 zeros. Na? Last 3 zeros omit. Okay. So in that way you have to write. If the amount is 50,000, 3 zeros omit. So we'll write only 50. Are you getting it? So this is important. Whenever you prepare balance sheet, 3 zeros you have to omit. Now coming to the balance sheet. First we'll focus on the liabilities. Before going to the liabilities, what is the format here? Particulars, schedule. Note number we used to write in the company accounts. No note, schedule we say. Every item we call it as a schedule number 1, schedule number 2, like that. Every item we give a schedule. So schedule, current year, previous year. 2 years amounts will be given to you. If only 1 year is given, then we'll write only one column. Okay. So particulars, schedule number, and current year and previous year 2. This is the format. Now let's focus on the capital and liabilities. Liabilities side we give a heading of capital and liabilities. Only one heading, capital and liabilities. Under this we have total 5 schedules. How many schedules are there? 5 schedules. What are they? First one is capital. Capital is schedule number 1. Second one is reserves and surplus. Schedule number 2. Even in company accounts also we used to write first share capital and reserves and surplus, right? Same pattern. First two you can remember in that way. Okay. And third one is deposits. Deposits. If someone is depositing into the bank, it's a liability for the bank. Whatever deposits the bank is going to get, that is a liability. So the deposits we are showing in schedule number 3. Capital, reserves and surplus, deposits. Then after that, borrowings. Company is borrowing something. Borrowings will be in the schedule number 4. Now tell me, capital, reserves and surplus, deposits, borrowings. 4 schedules. Able to remember? Borrowings means taking loan from another bank, RBI, and any other financial institution, that is borrowings. And fifth one is other liabilities. Other liabilities and provisions. Provisions means like RBD, reserve for bad debts, provision for bad debts, that kind of any provisions if we are providing. Able to remember 5? Capital, tell me. Capital, reserve and surplus, the deposits, borrowings, other liabilities and provisions. Got it? 5 schedules are over. Now let's come to the assets. Assets side we have how many schedules? 6 to 11. 12th is out of the assets. 6 to 11 we have schedules. 6, 7, 8, 9, 10, 11 means 6 schedules. Here 5 schedules, here 6 schedules. Now assets, How do you remember? First one is cash and balance with RBI. Cash and balance with RBI. With RBI will be having some amount. So that is cash and balance with RBI. First one means sixth schedule. Here it is sixth schedule because 5 already completed. Then seventh one is balances with bank and money at call and short notice. Balance with the bank. When bank is having some balance, that is will be showing in the next schedule, 7th schedule. Balance with the bank and money at call and short notice. Let me tell you money at call and short notice. Money at call short notice is temporary loan is given to the other persons. If somebody comes, they want loan. It's very temporary. Maybe one day, for one day or maximum 3 days. Okay, I'll tell you in detail about this one. Now right now you remember. So this is asset. Then they are giving, people are going to pay back it. So that is why we consider it as an asset. Money at call and short notice. Balances with bank, money at bank and short notice. Okay, first one is cash and bank balance with RBI. Second one is balance with bank and money at call and short notice. 6th, 7th schedule is over. Next, investments. When bank is having lots of amount, they are investing somewhere. That investments will be mentioned in the schedule number 8. After these two investments, schedule number 8. Then advances. Bank is giving some advances. Whenever we are giving advance, that's asset. Okay, advances comes in the next schedule, 9th schedule. Then after that, fixed assets. Fixed assets comes in the 10th schedule. Any other assets are there, that is other assets. Let us remember once again, cash and bank balance with RBI. Okay, balance with bank, 2nd schedule, that is 7th one. Balance with bank, money at bank and short notice, 7th schedule. Investment 8, advances 9. Okay, fixed assets, other assets. These two you will be able to remember. Investments, okay, advances, investment, advance, fixed assets, other assets you will be able to remember. Now you have to focus only on investment advances. Investment 8, advances 9, then after that fixed assets, other assets 11. Liabilities over, assets over. After the balance sheet, we have two items. One is contingent liabilities. Contingent liabilities we are showing in schedule number 12, but it is out of the balance sheet. Contingent liabilities means they may pay or may not pay. Liability may pay or may not pay, doubtful. So that is why we are not considering in the balance sheet. Contingent liabilities, this is. And after that, bills for collection. Bills for collection also may or may not come, but it won't be showing in any of the schedules. 12 schedules we have for the balance sheet. Bills for collection, it doesn't comes in any of the schedule. Remember this. While working on problem, you will be able to understand it. Now, did you follow this balance sheet format? How many schedules we have? Total 12 schedules. As first liability side, we have 5 schedules. Then after that assets, the rest of the 6 schedules. 5 plus 6 comes to 11. And one is contingent liabilities. Out of the assets and liabilities will be showing separately contingent liabilities. Okay, so this is balance sheet. Now each and every item we have to do it in separately, like notes or working notes you can say. Schedule number 1. Schedule number 1 is capital. Capital will be showing separately. We should not show any kind of detailed information, adjustments, plus or minus. Nothing should be mentioned in the balance sheet. Simply you do whatever you want. In the rough column, you have to show this working notes. Schedules, give a heading of schedules. Don't say working notes also. Schedule, schedule number 1. Capital, how do you got capital? Total information. Finally, whatever amount is there, that will be posted here. Clear? Now coming to first capital. Capital, first of all, remember authorized shares of so and so each at the rate of so and so. So this is authorized. Whenever you'll have authorized capital, write it and underline. 2 underlines means finished. We won't consider authorized. Authorized means they are authorized to issue the so and so shares. But how many shares they got? How many shares are applied? How many shares allotted by the company? That is important for us. This is not important. Only information we are writing. Authorized shares of suppose 10,000 at the rate of 10 rupees. So this we are writing and underline it over. Now what we have to focus? Issued, subscribed and called up capital. Issued, subscribed and called up capital. This is actual capital, na? So that we are going to write. How many shares? Shares of suppose say 80,000 shares at the rate of 100 rupees each. So that amount we are writing. Issued and subscribed and called up. This is some amount whatever is there. To that we have adjustments. One is unpaid calls. Some amount is not paid. Not paid means this amount is decreasing, so we are deducting. Unpaid calls always deduct, not paying. Not paying means capital amount whatever we have expected, out of that because of unpaid it is decreasing, so we'll decrease it. To that you are adding shares forfeited. If shares forfeited is there, somebody did not pay, company gave a warning, did not bothered, and company is forfeiting. Forfeiting means company is getting the shares, right? So forfeit, shares forfeited always to be added. And unpaid calls not paying, so deduct it. Deduct unpaid, shares forfeited, add these two adjustments. Remember, this is about the capital. Okay, authorized capital we are not taking. We are taking only which are issued, subscribed, and came for the call. This is capital. Schedule number 1 is over, right? Next, schedule number 2, reserves and surplus. Reserves and surplus. This we are focusing. Reserves and surplus is divided into total 5 parts. Different types of reserves. One is statutory reserve. Statutory, mandatory, compulsory reserve. This they have to maintain. Banking companies, it will be there. So one is statutory reserve, capital reserve, securities premium. Security premium also we consider it as a reserve. Okay, reserves and surplus, security premium, and revenue and other reserves and balance in P&L account. These 5 items comes under the reserves and surplus. Okay, anyhow all the 5 we are not going to get. Whatever is given in the problem, according to that we consider it. Where does it comes? Yeah, reserves and surplus means 5 items are there. What are those 5? Statutory reserve, capital reserve, and securities premium, and also revenue and other items at balance of profit and loss. Like this you have to remember, whatever is given, this comes under this. Schedule number 2 is over. Schedule number 3 is here, deposits. Deposits are here. Deposit means somebody has deposited in the bank. Customers deposited in the bank. Customers deposited in the bank means for the bank it's a liability. That is why deposits we consider it as liability. Now under deposits we have 3 kinds of deposits. In BFS, banking financial system, we have learned deposits. One is demand deposits. Demand deposits means current account. And savings bank deposits, savings bank account, whatever is depositing. And term deposits are fixed deposits. 3 deposits, current account deposits we say it as a demand deposits, and savings bank deposit and fixed deposit we say it as a term deposit. 3 types of deposits will be there. Whatever is given we consider that under the column of deposit. Customers deposited, for bank it's a liability. If bank is depositing, yes, what? If bank is depositing, then it will be asset. Now somebody is depositing here means it's a liability for the bank. Next, the third one is over. Next, borrowings. Borrowings means company is borrowing, company is taking loan, company is taking some money from outside. So that's borrowings. Borrowings is a liability. So borrowings is 4th schedule, schedule number 4. Okay. So what do we consider under the borrowings? First one is that you have to divide into 2 parts. One is borrowing in India, borrowing outside India. Borrowing India, borrowing outside India. from foreign countries also we can borrow, right? So like even we are giving to the foreign countries, in the same way we can borrow from foreign countries. So we are dividing in two parts: borrowing in India, borrowing outside. Now let's focus only in India. Whatever we are borrowing from a foreign country, only one amount, that if it is given, that we'll consider. But in India we have to consider certain points. What are those? One is borrowing in India, RBI, borrowing from RBI. RBI is like a godfather for the banking companies. Whenever company wants any kind of banking company wants any kind of funds, any problem, RBI is there, godfather. So borrowing from RBI and other banks, you can take from other banks also, so that other banks comes in the next step, and other institutions and agencies. We can consider other institutions and financial institutions, agencies also, that comes under the third part. So borrowings, India, three parts: RBI and from other banks and other institutions and agencies. And the other one is bank borrowing from foreign country. This is about the schedule number 4. Clear? Next, schedule number 4 is over. Other liabilities provisions. Other liabilities provisions, etc., we are writing here. So other liabilities and provisions, there are total 4 items are there. Other liabilities, apart from this, apart from the capital reserve, deposits, borrowings, whatever is there, that we consider it as a other liabilities. What are the other liabilities? First one is bills payable. You know this, and you know you'll not get creditors here because this is banking company giving the services. They're not selling any product, so no creditors. Bills payable. And a very important point, remember, inter-office adjustments. Inter-office adjustments means one bank to another bank, any kind of dealings are there. Interbanking system, we can say. In interbanking system, interbanking adjustments, if anything is there, so we consider it as liabilities when it is mentioned it as credit. If it is credit, inter office adjustments will say. If it is debit, it comes somewhere here. If it is debit, other assets we are going to show. Remember this point. Anyhow, this point we are going to discuss in future. Right now you remember inter office adjustments means if it is credit, will be considered it as a other liability. And third one, interest accrued. Interest accrued means interest payable. We consider it under the other liabilities. Interest payable. Others means including provisions. Any other provisions are there, that also we consider other liabilities and provisions, right? So this is fifth point. Total 5 schedules we have covered. After 5 schedules, we are totaling liability side is over. Now let's focus on the assets. Assets, first one is cash and balance with RBI. Cash and balance with RBI, sixth one here. It's very simple. Cash and balance with RBI means first thing is that here only 2 points are there. Cash in hand. Cash in hand, which includes foreign currency also. This includes foreign currency also, cash in hand. And balances with RBI, because they are saying there cash and balance with RBI means cash in hand, which includes the foreign currency also. And second one is balance with RBI, as the heading itself is saying RBI. Okay, so balance with RBI. It's very clear, nothing to worry. Second one is balance with bank and money at call, short notice. Okay, so balance with bank, money at call and short notice. This is also divided into 2 parts. One is in India and outside India. In India we have 2 points. One is balances with bank. Balance with the bank and money at call and short notice. As now just now I told, money at call and short notice means it is a very short period giving loan by the bankers to others. Others may be independent person or maybe a company, organization, partnership, can be anyone. Short period, 1 day, maximum 3 days. Within 3 days they have to repay back to the company. So that is why we consider it as a balance with bank and money at call and short notice. These 2 items in India we come. Outside India, whatever we get transaction, that we will also consider. In India we have 2. And the next one, what is over now? This 7th schedule is over. Now 8th schedule is investments. Eighth schedule, investments. When bank is investing somewhere, investing somewhere means it is a asset. So we are discussing that kind of investments here. Investments also, once again, investment in India, investment outside India. Outside India, we need not to talk much because whatever is given that we consider. In India, we have total 5 points, sorry. In India, investment in India, 5 points. First one is government securities. Government securities, we can invest it, and other approved securities where bankers are allowed to keep their investments in that securities, that is other approved securities. Shares, yes, they can purchase the shares also. Debentures and bonds. Others means like gold, etc. So these are all investments in India. Investment outside of India is, that's different. This is about the investment is over. Next one is advances. Advances means whenever the bankers are giving advance means that's a asset for us, right? For the bankers it is an asset. We are giving advance. In future it is going to work like an asset. So advances, we consider it as another schedule, that is ninth schedule. Investments 8 and advances 9th schedule. Now advances total 3 parts are the A, B, C. Separately I have written here. Advances A bit, B bit, C bit. Under A bit, few items comes. What are those means? Bills purchased and discounted. Somebody comes with the bills and they want to discount it. It's an asset for the bank. Bank will give the money at the rate of some discount. So that's an asset. So that's, and cash credits, overdraft, cash credit, whenever they are giving a credit basis cash, and overdraft facility. Apart from the amount deposited into the bank, they are withdrawing more than that. Then that is an overdraft. Overdraft facility is also giving by the bank. So for that purpose also, companies, for bankers, it's an asset. Overdraft facility. And loans repayable on demand. Loans repayable on demand. Loans they are giving, but it has to be paid on demand. And term loans. So this is one category. Second category is here, securities by tangible assets. Whether it is a category A, B, C, or whatever it may be, everything comes under the advances only. But it is categorized. In second category, securities by tangible assets and covered by bank / government guarantees, unsecured. Securities by tangible assets and covered by bank guarantees or government guarantees, and unsecured, which is not secured. These three things comes under the another category. Now coming to the third category. Third category is here, advances in India and advance outside India. Outside India we need not to discuss. Advances in India, total we have 4 points. First one is priority sector, priority basis, and public sectors, banks, others. So these 4 comes under the advances in India. Sorry, I need a water. Yeah. So this is about advances. Next schedule, 9th schedule is over. Now next 10th schedule is fixed assets. 10th schedule, fixed assets. Let's talk about fixed assets here. Very simple. Need not to worry. Fixed assets, first it is categorized into 2. One is premises, other fixed assets. Premises is compulsory for any banking company. So that is why it has mentioned very clearly. Premises, point number 1. Point number 2, other fixed assets. Any other fixed assets. That's about the fixed assets. Schedule 10. Okay. Now schedule 11, other assets. Apart from the all these 6, 7, 8, 9, 10, we have covered somewhat assets. No? If anything is there, so that comes under the other assets. Other assets. What are the other assets here? We have total 6 points. Point number 1, inter-office adjustments. Inter-office adjustments, it can be liability and it can be asset also. I'll give you depth information later. Right now you remember inter-office adjustments, it can be liability or asset. If it is debit, then it is a asset. If it is credit, then it will be a liability. Sorry, where it is? Here. If it is credit, it's a liability. If it is debit, it's a asset. Liability under other liabilities. Asset under the other assets. It's very easy to remember. Okay. Next, this is inter-office adjustment is over. Next, second one is interest accrued. Interest accrued means receivable interest. Any receivable is asset. Okay. Next, tax paid in advance. When we pay anything in advance, that's the asset. Tax paid in advance. Okay. Stationery and stamps. Stationery, stamps, etc. Also they keep in bulk in banks. So that is also asset. Next one, non-banking assets acquired against claims. If any other non-banking assets are there, that and others. So these are the other assets. Total how many points are? 6 assets, 6 points. So with this other assets, schedule number 11 over 6, 7, 8, 9, 10, 11 over. Okay. So how many are there? 6 here. There 5. Total up assets, total assets you'll get. So it should tally. Now, but still it's tallied. Now, problem is not yet over. Balance sheet not yet over. We have 2 more things to write. One is schedule number 12. What is this? Contingent liabilities. Contingent. What is contingent liabilities? Schedule number 12. We'll discuss that. Contingent liabilities, schedule number 12. Contingent liabilities means this liabilities may or may not come, may or may not happen. So possibility is there or sometimes may not be. That is why we are not considering it in the balance sheet. We are showing it separately. What kind of items? One is claim against the bank not acknowledged as debts. Claim is there against the bank but not acknowledged as debts. As debts they did not acknowledge it. May or may not. Next, liability for partly paid investments. Investment amount, partly amount is paid. What about the rest of the amount? If they pay, that will become full investment. If they are not going to pay, then that will be a partly. So that is also we consider under the contingent liabilities. Next, liability, LIA, liability on account of outstanding payable. Outstanding means, okay. So liability on account of outstanding forwarded exchange transactions, etc. And also guarantees given on behalf of the constituents. Guarantees given. Bankers are giving the guarantee. Somebody is taking loan or some company is taking loan. For that, bank is giving the guarantee. If the person is not going to pay, then who is responsible? Who is liable? Bank is liable. So that point we are talking, guarantee given on behalf of the constituent. Next, acceptances, endorsements and other obligations. If any acceptances are there, that is also doubtful, na? And other items for which the bank is contingently liable. If any other transactions where the bank is responsible, where the bank is liable. So these are all comes under the contingent liabilities. Clear? And lastly, bills for collection, if it is there, that will be showing separately, but it doesn't comes under any schedule. Schedules we have only 12. We have to memorize these schedules. Any transaction is given, any transaction, you have to remember that. So this comes under which column? First of all, identify that is it an asset or liability. If it is an asset, under which schedule it comes? Asset, we have total 6 schedules are there. Under which schedule it comes? If it is a liability, under which schedules out of 5? So this you have to make it clear. Screenshot? Yes. Do not worry, very easy. Next class I'll explain profit and loss account, that is form B. This is form A, form B, format also I'll explain, then after that slowly we'll go. After that we'll work out few short problems, then we'll go to the essay problem. Okay, very easy. Write it very clearly, notes and everything, underline it, use the scale, sketches, this and that, and your notes should be very neat and clean. and whenever you open the book, it has to give you a motivation that yes, I have to read. In that way, you prepare it. So see you in the next class. Stay connected. Good luck.